All right, guys, welcome back to another episode of the Black Bullion Show. Economic environment fundamentals. I've been using these words, a lot recently as a counterpoint to the risk on news that I've been reporting on and others have been recently. So what's with the disconnect between the two? Well, one is a view from more of a macro lens, and the other is a view more from a micro lens. One focuses on the long term and other focuses on the short term. Both are important, but today we'll be taking a look at long-term effects on gold and silver. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit that like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Now, guys, we just fell off a cliff. That's right. The Q2 numbers for velocity of currency have finally come out, and it's by far one of the steepest drops between quarters we have. Pretty much going as far back as 1959. Check this out, guys. In Q1 of 2020, let's move this mouse right over here to Q1 2020. Q1 of 2020, we were at 1.381 in velocity. By Q2, we plummeted to 1.097. That's a huge drop. And as you can see here, and let me move this here so you guys can see that better. And as you can see here, it's one of the steepest drops on record between quarters. I don't know how much more I can belabor that point, but that tells you a lot about the mindset of Americans these days. Simply put, we're scared and we're hoarding currency at a rate unseen so far on record. Now, when you take a look at the GDP deflator here, things actually begin to make more sense. There's a little bit more clarity here. Now, this is a measure of domestic inflation, and we actually began to trend down in Q2. Here's Q1, and then we start to trend down here in Q2. The main factor that likely drove this was the steep decline in velocity as opposed to this factor right here, which is the actual growth of M2 money stock. Now, this thing began to skyrocket in March, as you can see here, obviously due to the Ronies. But the graph can be deceptive and make you think that Q2's continued growth in M2 far surpassed Q1's. But though it did surpass it, it didn't surpass it by much. There was actually a gain of $1,195.6 billion in Q1, and there was a $1,637.4 billion gain in Q2. That's only a difference of $441.8 billion. So because of that, pretty much very small jump from Q1 and Q2 in M2 money stock, velocity was easily able to drive domestic inflation down in Q2. Now, that's the macro domestically. Next, we'll be looking at the start of Q2, which is July, and how increased inflation has continued to erode the purchasing power of the dollar, and it allowed gold and silver to shine brightly in July. So let's take a look here. Now, this article here refers to the CPI, and you guys know how I feel about that. But one consolation is that the graphs that are shown only go as far back as 2007. So that at least shows that there will be some consistent methodology behind the numbers of the CPI. Though I still don't agree with the actual methodology. At least it'll just be the one methodology. But let's get into this. Dollar's purchasing power drops to lowest level, to lowest ever. Inflation heats up as Fed wants after simultaneous supply and demand shocks. So let's get started here. And I'll begin. Overall inflation, as measured by the Consumer Price Index for urban consumers, jumped 0.6% in July from June, after having jumped 0.6% in June from May, wiping out the declines in March through May. Compared to July 2019, CPI was up 1.0%, still held back by the 20.2% year-over-year decline in energy prices. The June and July month-to-month increases of 0.6% each were the largest two since 2009. The CPI without food and energy also rose 0.6% in July from June and was up 1.6% from July last year. When we say that the CPI in July rose 0.6% from June, we mean that it rose from an index value of 257.2 to an index value of 258.7. We get this chart that looks like progress, like something good has been happening, with a fairly consistent uptrend from the bottom left to the top right, sort of like a stock market chart. And the Fed and economists want this line and lines of other inflation indices to move up at a steeper angle, and they then take great pride in it when it does. So as you can see here, here's the Consumer Price Index as it moves up. But take a look here between around 2020. It dropped, just like how the GDP deflator, remember the GDP deflator, this is the US inflation, it dropped in Q2. As you can see here, the CPI dropped here as well in 2020. Let's continue. But the Bureau of Labor Statistics also offers the corollary index, the purchasing power of the consumer dollar, and it just hit a new all-time ever low. Note the purchasing power recovery during the financial crisis, when consumers could actually buy a little more with their labor for a few quarters. Take a look here, guys. This is extremely scary. We were actually bumped up a bit in 2020, and then we just started to trend down even more. Now, this definitely helped move the needle for gold. Let's continue. When the Fed wants to increase consumer price inflation, it in effect wants to decrease the purchasing power of the consumer dollar. Currently, the Fed is very impatient about chopping down the purchasing power of the dollar. To communicate this, Fed Chair Jerome Powell keeps repeating so eloquently that the Fed isn't even thinking about containing the decline of the dollar's purchasing power when it speeds up. A decline in the purchasing power of the consumer dollar means a decline in the purchasing power of labor. And consumers who are in their real life workers need a corresponding increase in wage inflation. For employers that are able to raise prices but don't have to raise wages, it means cheaper labor. And for decades, this has now been one of the big issues in the US economy among the lower 40% of workers who provide this cheaper labor. So guys, this in and of itself is very important. Since the early 70s, there has been a divergence between productivity and wages. You can take a look at that on this website called WTF Happened in 1971. It'll show you all that. I believe that's actually the first graph that you'll be shown. And you'll see that wages have not kept up at all. So I hope that this helped you in making sense of why gold and silver behaved the way it did in July. think about it. We had subdued inflation in Q2, but the money printing was going through the roof. It didn't take much in the way of inflation to drive investors into gold and silver in a risk-off environment. Why? Well, the main alternative was the US 10-year, and by then we were heavily into negative real yields. So guys, that was a pretty easy decision to make in July. And if you think about it, that inflation post minor deflation play may be a look into our future when velocity really picks up years from now. We could have hyperinflation that will basically pale this performance of gold and silver in comparison. All right, guys, thanks again for watching. Let me know what you think about this in the comments section below. Please give the video a like. Please subscribe if you're new. It's Black Bullion.